What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. Hi everybody, Ryan Pulis here with another episode of the CPA Zone. Today, we're going to talk about what retirement plan is best for me and my business. So let's start with some basic plan types. We have plans that are considered individual plans and those that are adopted by your business. So on the individual side, you have traditional IRAs and Roth IRAs. A traditional IRA is an account that allows you to contribute up to $6,500 a year in pre-tax contributions, plus a $1,000 catch-up if you're over age 50. Now, sometimes there are income limitations that come into play with a traditional IRA. For example, if you are not covered by a plan at work, there is no income limit. If you're married and neither you or your spouse are covered by a plan at work or through a business, there's no income limit. You can make deductible contributions. However, if you're covered by another type of retirement plan through your work or your business, then you can only make deductible contributions at under certain income levels. If you're a single filer, that income level is $73,000 a year. It starts to phase out the deduction and is fully phased out at $83,000 a year. These are 2023 numbers. If you're married, the phase out begins at $116,000 and ends at $136,000. Now, if you are not covered by a plan at work or your business, but your spouse is, the income limitation changes somewhat. Then the deduction phase out begins at $218,000 and is fully phased out at $228,000. So you can make non-deductible contributions if you're over these income limits and they apply to you. And what this does, this will establish basis in your IRA account. So a portion of distributions in retirement come out tax-free if you have basis in the account. So let's say you have a traditional IRA account. You also have a plan through your business, and that income level, your current income level, puts you over the limit to make deductible contributions. You can still put money into your traditional IRA account. You'll forego the current tax deduction, but that's going to establish basis in the account, which means the money when it's pulled out in retirement comes out tax-free. So normally with a traditional IRA, you get a tax deduction up front, and when you take the money out during retirement, it's taxable. The next type of individual plan is a Roth IRA. So with Roth IRAs, the contribution limits are the same as the traditional IRA. So it's $6,500 a year plus a $1,000 catch-up if you're over 50. There are income limits with the Roth IRA. So when your income hits or exceeds certain thresholds, you can't contribute to an IRA, at least not straightforward. So with a Roth, the income limits for single filers start at $138,000. That's the upper limit. And then the deduction or the contribution amount begins to phase down and is zero at $153,000. If you're married, that range is $218,000. That's the top limit when it starts to reduce the amount you can contribute. And then it's fully reduced to zero at $228,000. However, there is a strategy called the backdoor Roth IRA that allows high income earners to still make contributions to a Roth IRA. And remember, with a Roth IRA, you're contributing after-tax money. That money grows tax-free, and then it comes out tax-free in retirement. So Roth IRAs are really the gold standard of retirement accounts. So back to the backdoor Roth IRA, if you're over the income limits, you can make a non-deductible contribution to a traditional IRA and then convert that to a Roth IRA. So it's an extra step involved, but it allows you to contribute to a Roth IRA if your income is over the limits. Now, one thing to note, if you have an existing traditional IRA account that's open, a traditional IRA or a traditional SEP IRA, you have to convert those dollars to a Roth before you can use the backdoor strategy. I guess the IRS just kind of views it as you already have these funds out here, convert those first before you can contribute to a Roth IRA using the backdoor Roth method. So those are our two individual retirement plan types. These next few plan types we're going to discuss are plans adopted by your business. So the first we have is what's called a simple IRA. So this is available to businesses with 100 employees or less. There's a maximum contribution limit of $15,500 and a $3,500 catch-up if you're over age 50. So that gives us a total of $19,000 that can be put away into a simple IRA. Again, these are 2023 numbers. So the way this works, the $15,500 would be employee deferrals. You also have an employer match. So if you have employees and they're contributing to the simple IRA, you have two options. You must either make a matching contribution of 3% of that employee deferral or a 2% non-elective contribution for all eligible employees, whether or not they contribute. So an example would be of a 3% match would be, let's say you have employee A, their yearly compensation is $50,000 and they contribute 5% to their simple IRA. So they have a deferral of $2,500. You, as the employer, contribute a 3% match, which is $1,500 to match their contribution. With the 3% match, you do not have to make a contribution to the employees that aren't contributing. So let's say you have 10 employees and this is the only employee contributing. Well, by using the 3% match, which is a little bit higher, you don't have to worry about contributing to those employees that are not participating in the plan. If you went with the 2%, then you have to put in 2% for all employees. That makes sense. The next plan type is what's called a SEP IRA. Now, this plan type is available to any size business. There's a maximum contribution of $66,000 for 2023. So we're getting a bit up there in the amount you can put away. Now, that $66,000 is calculated based on 25% of W-2 wages. Or if you are self-employed and filing on a Schedule C, it would be 20% of your self-employment income. So when you have employees, then you as the employer must contribute the same percentage to employees as you contribute for yourself. So only the employer contributes with the SEP IRA. There are no employee contributions. They cannot make deferrals on their own. So if you contribute 10% for yourself as the business owner, then you must contribute 10% of each employee's W-2 wages. So each employee with a SEP IRA basically has a traditional IRA type account set up for them as part of the SEP IRA plan that the employer contributes to. So let's look at another example. Let's say you are a self-employed business owner with one eligible employee. You decide to contribute 10% of your self-employment earnings, which are $100,000, to a SEP IRA. So you're going to contribute $10,000 for yourself, 10% of $100,000. Your employee has W-2 earnings of $50,000 for the year. You must also make a 10% contribution for this employee of $5,000, 10% times $50,000. So your total SEP contribution for the year, which is deductible, is $15,000. So $10,000 for you and $5,000 for your employees. Now, the Secure 2.0 Act allows Roth contributions to SEP IRAs and simple IRAs starting in 2023, where previously you were only allowed to make traditional type deductions, which are current year deductions, and they come out and are taxable in retirement. With the passage of the Secure Act, you can now have a Roth component to your SEP IRA and simple IRAs. Now, the last retirement plan type we're going to talk about today is a 401k. So most people are probably familiar with this. If you've had any job in the past, you've probably had the option to contribute to a 401k. So the 401ks allows employees to defer up to $22,500 into the plan as a deduction each year. This reduces the taxable wages on a W-2. And again, 2023 numbers, $22,500 with a $7,500 catch-up for employees that are age 50 or older. So that's a total of $30,000. Employers are also allowed to make matching and or employer contributions up to the maximum limit for 401k plans, which is $66,000 for 2023. So that's the same max that's allowed with the SEP IRA. However, for those that are aged 50 or older, get the catch-up contribution of $7,500, which does not apply to a SEP IRA. That brings the total up to $73,500. So the 66 plus $7,500 catch-up is $73,500. Now, a 401k is generally used by larger companies. However, any type of business can open them up. And if you are a single member owner with no employees, there's something called a solo K, where you're the only participant in the plan. These are generally going to provide a bit more bang for your buck than the SEP, because to max out a SEP IRA for 2023, you need to have profits of at least $264,000. 25% of 264 gets you to the $66,000 max. With a solo K, you can put the entire first $22,500 of earnings into the plan, or $30,000 if you're 50 or older. So let's say, for example, you as a single shareholder of your S corporation with no employees, you pay yourself a salary of $100,000 and you decide to open a solo 401k. You can put away $22,500 as your employee deferral. And then on top of that, the 25% employer contribution would be based on your $100,000 W-2 wages. That gets you a total contribution of $47,500. So with the 401k plans, the employer match or employer contribution is limited to 25% of W-2 wages or 20% of self-employment income if you're on a Schedule C. So it works like the SEP IRA, that 25%, once you get past the deferral. So the deferrals come first, that first $22,500 or $30,000 if you're over 50. So back to our example, we're putting away $47,500 based on a $100,000 salary into our solo K. If we decided to go with a SEP IRA, you'd be limited to 25% of your W-2 wages or $25,000. So you're getting the $25,000 with the solo K plus the deferrals of $22,500 for a total of $47,500. So you get a bit more bang for your buck in terms of deductible contributions with the 401k. Now, you should know with a 401k plan, there are certain reporting requirements and additional administrative costs that the SEP doesn't have. So once your 401k plan has plan assets of greater than $250,000, you're required to start filing Form 5500 for the plan each year, which is going to incur an additional cost. But it's a relatively simple filing, and you can usually have it done for a few $100s. So again, to reiterate, we have traditional IRAs. You can put away $6,500 plus another $1,000 of deductible contributions in 2023. The Roth IRA, all your contributions go in after tax. They grow tax-free, come out tax-free. Same contribution limits as the traditional IRA, $6,500 plus $1,000 catch-up if you're over 50. The simple IRA is a plan adopted by your business that covers you and employees. With the simple IRA, you can put away up to $15,500 each year with a $3,500 catch-up for those age 50 or older. SEP IRA, maximum contribution based on 25% of W-2 wages or 20% of self-employment income with a maximum contribution of $66,000. And last but not least is the 401k. You have elective deferrals up to $22,500 with a $7,500 catch-up for those age 50 or older. On top of that, you can use the employer match of 25% net income, getting up to that maximum of $66,000 or $73,500 with the $7,500 catch-up for those age 50 or older. So hopefully this gives you a bit of insight into which plan may work best for you. When you're starting out, you may want to just stick with a traditional IRA or Roth IRA. And then as your business grows, look at the simple or a SEP or 401k plan, depending on your facts and circumstances and whether you have employees or not. So that about does it for today's podcast. I hope you found value in this information. If you did, would you mind leaving a 5-star review or hitting the like and subscribe button? Until next time, have a great day. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away.
We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.